Everyone, and thank you for joining us at the first of our Ride the Markets with UOBAM webinar series, which kicks off with today's topic, Investment Outlook 2021, the year ahead. My name is Barry Tay from the Marketing Communications team, and I will be your host this afternoon. Before we begin, I would just like to go through a few technical housekeeping points. At the bottom of your screen are engagement tools that you can use. All the items are resizable and movable, so feel free to move them around to get the most of your console space. You can expand your speakers or slide windows, or maximize either to full screen by clicking on the arrows in the top right corner. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. We will try to answer these questions during the webcast, but if a fuller answer is needed or we run out of time, we will come back to you later. There's also a poll where you can share your views on what is likely to happen in the markets. Lastly, a resource list with some material from today is available for you to download. For today's event, we have a bite-sized, insightful program planned for you over the next hour. Now, without further ado, let me hand over to UOBAM Group CEO Teo Boon Kiat with his opening address. Over to you.
Thank you, Barry. Ladies and gentlemen, a very warm welcome to the first of UOBAM series of investment webinars for 2021. It is a great honor that more than 1,000 people all around the region have registered for today's event. Thank you for taking the time to join us and for your continued support. Due to the current social distancing rules and limits to attendees at open events, we are restricted to holding events virtually, at least for now. Hence, as Barry mentioned, we are organizing a series of shorter, bite-sized virtual seminars entitled How You Can Ride the Markets in 2021 with UOBAM. In this series, we will explore trends in emerging and exciting areas such as sustainable investing, megatrends and innovation, and closer to home, an on-the-ground view of Asia. We are kicking off the series today with a more broad-based assessment of how markets are likely to perform on the heels of vaccination programs happening now, as well as better clarity in the political arena now that the US elections and Brexit are behind us. And we'll also look at what will affect markets, from catalysts to possible speed bumps. Looking back at last year, we can literally say that hindsight was indeed 2020. It was a year without precedents, historic market highs and lows, an unheard of negative oil price, seven-fold surges in some large cap stocks, an extremely choppy rise in a host of asset classes, and also the emergence of Bitcoin and digital currencies. The main culprit was, of course, the mother of all black swans, the coronavirus or COVID, an invisible pathogen that wreaked economic havoc and disrupted financial markets across the board. As a result, our fund managers found themselves not only tracking macroeconomic data and earnings trajectory, but also becoming experts in medical trends, lexicon, and curves of a non-economic kind. I learned during this time that flattening the curve had nothing to do with fixed income. Thankfully, though, for the investment community, we had the decisive and coordinated response from the major central banks. It was swiftly followed by robust and outsized fiscal stimulus from governments all around the world, including here in Singapore, and not just one, but a series of supplementary budgets. And now, finally, after months of uncertainty, a second word has come into the picture: vaccine, a word that is now mentioned frequently in our daily conversations, and which we all hope will be more readily available with the rollout of inoculation programs in many countries. Hopefully, by the time we next meet, some of you would have already been vaccinated, which collectively, when administered to huge populations, will help leave the worst of 2020 behind us. Or as we say, there's finally light at the end of the pandemic tunnel. As the Greek philosopher Heraclitus said more than 2,000 years ago, you cannot dip into the same river twice. In short, all in life is fluid. Conditions evolve, change, and dare I say, mutate. And so too markets. They are never at a standstill, and neither are businesses, people, and investors like ourselves. Which was precisely what transpired at UOBAM. We did not just sit still and hunker down, but we instead used the opportunity during the COVID crisis to accelerate our transformation journey. We have made great strides in sustainable investing since becoming almost exactly a year ago a signatory to the United Nations-supported Principles for Responsible Investment, or UNPRI. That was a clear signal of our commitment to integrate ESG considerations into our investment policies and practices in order to develop sustainable solutions for our clients. I'm also glad to say that we were able to pick up a few awards in ESG investing along the way to add to our other fund awards during this very difficult year. Likewise, we are also able to accelerate the launch of our robo-advisor, UOBAM Invest, in Singapore and Malaysia to a new catchment of investors. We aim to extend the service across the region and also in partnership with like-minded regional players such as Grab and Singtel, amongst others. And with the year barely a month old, UOBM has already strengthened our regional presence with the addition of another fund management company, this time in Vietnam. This elevates UOBM's presence now to 9 markets in Asia. Now let me not speak too long and steal the thunder away from today's real star, my colleague and UOBM's Head of Multi-Asset Strategy, Mr. Tony Raza. Today, Tony will present his views on where markets will likely head and how to position your investments in the coming year. But before that, let me, on behalf of all my colleagues at UOBM, wish all of you in advance a healthy and prosperous Year of the Ox, as well as thank you for joining us today. We would certainly not have been able to arrive at this point in our journey without your continued trust and support. At UOBM, we strive to always innovate and find new ways and channels to meet our clients' needs. We will continue to hold true to our time-tested commitment to uphold the highest professional standards in how we manage your assets and remain true to our values of honor, enterprise, unity, and commitment. So thank you very much, and I hope that you'll spend a useful hour or so with us today. But before that, a video taste of what Tony will be speaking about. Thank you and have a good day.
Hello, everyone. Thanks again for joining us today. I look forward to this opportunity to explain what we're seeing in markets and how we're positioning our funds, as well as what we're advising clients and investors to do this year. So firstly, let me start off by recapping what we saw in the past year. On this next slide, you can see that excuse me. Sorry, here are our poll questions. I forgot this is where I wanted to start. So first, there are many interesting things that I'd rather gather people's advice on. And so the first one I think is going to be important for this year, and I know I get a lot of questions about, is what will this pace of vaccinations look like? So I think you all have within your councils the ability to answer this poll question. And the first one is, what will the doses of the COVID vaccine rollout look like in the US? And specifically, then the question is, when will the first 100 million people be vaccinated in the United States? And so also, just to give you a little bit of background, the US population is 330 million, so this will be roughly the first third of the American population. And the question is, will it be done before March, before May, before July, or not before August, later than that? Go ahead and fill this out, but I guess as one more bit of information, I would highlight that, it is President Biden's, one of his initial plans in his first 100 days is to vaccinate 100 million people within the first 100 days. So that would put us by roughly April. I see you all looking at the answers here a little bit more cautious. You're thinking it might not be until August, and I think there's some reasons to be cautious. But nevertheless, the objectives are ambitious. The ambitious is to get the first third of the United States done by April, and that's what Biden is putting out as an agenda. Let's go to the next question. On the next question, we'll have, what will the recovery look like, and especially the recovery in earnings? How long will it take before company profits are as high as they were before the crisis. In specific then, which quarter will see quarterly earnings match the fourth quarter of 2019? Will be the second quarter, third quarter, fourth quarter, or will it take even longer to 2022? And the fact is, we have consensus estimates of analyst forecasts, and I'll tell you what they're saying in a moment, but I guess to me, this is an important part of when will there be just as much earnings as before, because that obviously will be a key support to markets. So I think we should have the results coming up soon. Okay, and here I see a sense of caution as well, that the plurality of the answers here are coming in for 2022. But again, if you actually poll the analysts that are doing the forecasts on the companies in the S&P 500, they actually have the S&P 500 earnings in the second quarter of 2021 matching that of the fourth quarter of 2019. And this is because already the earnings are starting to come in ahead of expectations, and they've been having to revise upwards, and they're projecting out a little bit more. And so they have it even as soon as the second quarter. Let's go to the next question. The next question then is, when will the Fed raise the Fed funds rate? Will it be this year, next year, 23 or 24 or later? And, just as a background on this too, in the last cycle, the recession occurred in 2008, and we really didn't get Fed fund rate hikes until 2017. So it took almost 10 years. This cycle, there's a lot of reasons to think it could be different. There's more policy. This recession driven by a pandemic isn't quite the same as what we went through last time. But nevertheless, the path of interest rates will be a key function of what's going to affect markets. So I think we should have the answers coming up soon. And in this one, the plurality of the answers is 2023. Quite honestly, I think that's a fair answer. I think that's the way I would answer it. But there's a lot of uncertainty in both directions. This cycle could end up looking more similar to last cycle. Then even 2024 will be too early. Or it could be different, and we may be surprised and be feeling pressure sooner than that. On the next question, we have questions about fixed income markets. And so our question is, which fixed income market should outperform in 2021 geographically? Will it be the US, Europe, Japan, or Asia? And I think maybe just a little bit of background on this. Obviously, fixed income markets, in particular credit markets, were feeling a lot of stress in the midst of the crisis, but those credit spreads have really quickly gotten back to pre-crisis levels, especially in the US. In Asia, your spreads are a little bit wider still, haven't fully gotten back. And I guess the question is that a sign of problems, or is that a sign that there's still a bit more potential for Asia to gain? So how about let's look at the answers. Oh, okay. This is a strong percentage for Asia, and I would agree with that. I look at the spreads in Asia and still see them as looking quite attractive, where they've narrowed pretty aggressively in other parts of the world. Okay, I think we have one final question, and this is a similar question to the one before, but this is for equities. So which equity market will outperform in 2021? The US, Europe, Japan, or Asia? I guess as a bit of a background, we've been overweight the US for the last 7 years. And it's generally borne out. And as a matter of fact, for the last 10 years, the US has been the top performer, and Asia has lagged behind in the last 10 years. But how about for next year? What's going to outperform? Let's see if we can look at some answers. And here, yeah, strong preference for Asia. Still some sympathy for the US here. I would admit, I'll explain in our house view, we do like Asia this year. It's underperformed by 150% in the last decade compared to the US. So for the first time in a long time, we're neutral on the US and overweight Asia. Okay, so I think that gives a little background. It's interesting to see where everyone's at and what people are thinking. Let me go into summarizing our views on markets. So the first thing I wanted to start off then was a recap on 2020. As Bunket was saying, really it was a stunning year. I've been in finance since 1990, and I've never seen economic devastation like what we saw last year. And yet, looking at this chart, which is the performance of all the asset classes, obviously there was sharp contractions in the markets back in March last year. But in the end, this has turned out to be a remarkably strong year for almost all asset classes. So I think it challenged the notions of how financial markets work in reviewing a year last year. So let's go to the next slide. Then let me start to summarize how we're thinking about 2021. And we see 2021 is driven by three key factors. We say that the first thing will be the vaccine rollout, and not only sort of improving the health of individuals, but also sort of improving the health of economies and the fundamental macro backdrop. We think it's a year of growth and recovery. When we look at GDP, or if we look at earnings, we expect both to be growing at significantly high levels, higher than we've seen in a long time. That's obviously coming because we had a low base last year, but nevertheless, when we look at company by company or country by country, we really expect to see pretty healthy and strong GDP growth numbers or earnings growth numbers. And then the third element is that all this growth comes in an environment where we think we're pretty much guaranteed low rates for at least a couple of years. And that, in combination, really historically, it's pretty much impossible to find a backdrop where you've had such supportive policy and such above average growth, and it didn't turn out to be a good year for markets. And so that's our view. We think this creates a healthier environment to invest in 2021. But if we were to highlight the concerns, the first one would be that this has rapidly become a fairly consensus view. Everyone has seen the fact that the vaccines look effective and that this should help growth in 2021, and that the Fed's helped guide us to a low rate environment. And with that combination, there are not many people now who don't think this looks like a healthy backdrop for investments. And if there's a concern, then it's just that it's a little bit too consensus a view, and that valuations are getting pushed up to fairly high levels because everyone's on board with this. And high valuations mean that there's risk of a pullback at some point. Politics remains a risk. Trump is no longer the president, but even with Biden, there'll be uncertainties around the world in many countries, and geopolitical risks are probably something that is going to continue to be an issue throughout the year. The pandemic, despite the vaccines, there's still lots of uncertainties. The current wave is very problematic, and even the rollout of vaccines, there's a lot of uncertainties around. And then finally, ultimately, what could challenge a positive recovery view is that if inflation comes back sooner than expected, then this third point about low rate backdrop becomes more questionable. So given all that, then we see several key calls that we're making in the way we're positioning our funds and what we're recommending to clients. So the first is we do have a bias towards overweighting risk assets. That's things like equities, credits, commodities. They should get a fair amount of support in a good growth year like this. The second point we would make is that the way assets have performed over the last year has been uneven. There's been lots of stocks that have really pushed up the index, and there's been a lot of laggards. We think rotations will be a key play throughout the year. Finding those that have been laggards, but we're seeing signs of recovery, will tend to be probably investment opportunity through the course of the year. And we think this is a good year for good fund managers who can pick stocks. A third key point is that we do expect bond yields, things like the U.S. Treasury 10-year bond yield. We do think it rises through the course of the year, but it is our view that it rises modestly, that bond yields are fairly well anchored by low interest rates. And therefore, our guidance is that the 10-year bond yield in the first half of the year probably ranges between 1 to 1.3%, maybe starts to push to 1.5 by the end of the year. And that'll be a bit of a headwind for things like government bond performance, but I don't think is that problematic for markets overall, and I think will look fairly gradual. The next point is that we would highlight that when it comes to the US dollar outlook, that in times of strong growth like this, that tends to lead to a weaker dollar, and we tend to see more like emerging market currencies. We'd also add that U.S. policy, both their fiscal policy and their monetary policy, both sort of add up to, again, pointing towards a weaker dollar backdrop, and also the end of, well, not the complete end, but at least the end of Trump's rhetoric in his trade wars. I think will take a little bit of the upward pressure that the U.S. dollar was seeing off the table. So overall, I wouldn't state it too strongly. We see sort of a gradually weaker dollar trend, but not necessarily very weak. For the most part, we see that the U.S. economy is going to hold up fairly well, and if so, I think that limits the downside on how much weakness we could see in the U.S. dollar. The fifth point here is that we do like Asia, and I saw in those poll questions, most of the viewers here are pretty much on board with that. As I mentioned, Asian equities in the last decade, U.S. equities are up 250%, and in the last decade, Asian equities are up 100%. So that's 150% difference over 10 years. That's been a weaker decade for Asia, and I think as we're starting this decade, I think Asia's in position to sort of coup back some of that underperformance. And then certainly everything we're looking at now, Asia has handled the pandemic better. It's seeing good economic trajectory. China's becoming pretty much one of the strongest growth pillars of the world. And the fact is that we believe in this weaker dollar path, that tends to be a backdrop where Asia outperforms as well. So then finally, we do also highlight that certain investing styles are likely to become important in this sort of low interest rate world that has growing markets. We like income, that balances both sort of credits and dividend yields. These income cycles tend to last long when you have a real commitment to low rates. And then alternatives in the world of sort of low rates and sort of just lower returns in general, alternatives that tend to have more absolute return mindsets, they see their future returns look like they're holding up a bit better than some of the other asset classes where I think we have to accept lower returns in the future. Okay, so that's a quick summary of our views. Let me go through some of the details. The first thing I wanted to start on is the pandemic, and the current pandemic is obviously not good. The number of cases has been rising, and on the next slide, the number of fatalities have been rising as well. So in all counts, whether it's fatalities or cases, obviously the problems around the world are enormous, and I know many clients ask me, how do markets hold up so well in the face of this? But let me get into it, but first just wanted to be clear about what we're facing. On the next slide, we do highlight, obviously, what markets are looking forward to are the vaccines. And we would say, really, this is nothing short than a historic achievement of science. In particular, I like to tell the story of the Moderna CEO, because it was in 2012 when he left a big pharma company to join Moderna, which was a smaller company that had no products at the time. And he told his wife that Moderna is a company that if this mRNA technology can truly kick in and they can take advantage of it, then it can change the course of science. If not, then obviously he's made a mistake becoming a CEO of a no product company. But as we sit here today, it's quite a remarkable achievement, and the implications go far beyond these vaccines. So this is an exciting period, and I think that's where a lot of the market enthusiasm comes from. On the next slide, we would highlight that despite the optimism, there are concerns that the distribution of these vaccines can be challenging. Obviously, we need to produce these vaccines in billions of doses. The supply chains can get complicated. The cold chain networks can be complicated, especially as we get to some of the more emerging markets. Controlling the delivery of this to be sustained on a mass volume basis around the world can be challenging. Even just the documentation, because everyone has to come back for a second dose, that'll be complicated. Will everyone remember to come back, and will we lose track of that? And so anyway, there's a whole host of issues that we need to be aware of that could disrupt the rollout. Nevertheless, we would say that as we're monitoring data now, and I think we're starting to get more and more of this data, I think it's fair to say that Through the end of December, the rollout was a little disappointing. Through the end of December, there was the hope to get, as much as 20 million doses out in places like the US. And even as of right now, they're only at 12 million. And as you can see in this chart, China's at 10 million, the UK is closer to 5 million. So we're starting to see the rollout, but it hasn't been a completely smooth start either. On the next page, you can see that we also track it as a percentage of the population. And so places like the UK are doing pretty well. The UK is close to about 7% of its population already vaccinated. This chart also shows places like Israel kind of show the potential of what can be done. Israel, being a smaller country, did have the connection with the US to lock in enough supply. And they have a universal healthcare system, and they've really been able to roll this out quickly. And they're close to 30% of their population has already been vaccinated. And then finally, on the next slide, I would also highlight that what we're tracking is also the delivery of the doses per day. And this is important because in places like the U.S., Biden has put it as his objective to do 100 million doses in the first 100 days. And if so, then the U.S. needs to do 1 million doses a day. And as of right now, they're pretty much just getting to it. In recent days, they've started to do 1 million doses a day. So we'll see if it's possible to keep this up. There's reasons to believe that this current round is largely being done in the hospitals, and it's a bit easier to do it when you're going to hospitals and tracking down all the doctors. When you actually have to go into the heart of the population, it may slow down, or they may be able to be getting better about this stuff, but it's something we're going to track. The next set of questions really are about how long is it going to take to really make a difference. So the first thing to point out is that one of the shortcuts, obviously, is to vaccinate the elderly first, and pretty much all countries have that as their game plan. And if you do so, the fact is it's more manageable to get the doses out there. So for example, on a sort of global basis, if you can come up with 450 billion doses, then you can vaccinate all the elderly. And that number really is quite achievable. In places like the US, instead of 100 million doses, you really only need 40 million doses, and you've covered all the 70-year-olds in the US. And if you've covered all the 70-year-olds, then effectively you've already reduced the number of deaths by 80 to 90%. So this can be done in the first quarter of the year, and I think we might be surprised how quickly the number of fatalities really sort of plummet to a fraction of where they are now. And then this next slide also shows that we're tracking a lot of the forecasts that are put out there about how fast countries around the world can achieve herd immunity. But there are many forecasts that look like this, and this one's from Deutsche Bank in particular. And they're highlighting that they're expecting that most of the big G3 regions to get to herd immunity by the middle of the year. That's roughly 60% covered. So that's a little bit of a blue sky scenario, assuming there's no major hiccups in the rollouts. But I think when I talk to clients and investors, most find this quite an encouraging sign that leads to conclusions that, oh, maybe we can start to get back to more normal by the second half of the year. So then on the next slide, we would say that if we get that type of rollout for vaccines, and we can start to think, be more convinced that this is a year of recovery, then our investing process becomes a lot more simple. And so I think I've shown this in presentations before, but this is the UOB Asset Management Investment Clock. And again, after going through a sharp recession like we had last year, then when we get into more of a recovery stage, we would draw the hand of the clock pointing to this recovery phase of the cycle, and that at this phase, it's a lot easier and it's a lot usually more clear on how to invest. And usually at this stage, you have several years ahead of you of expansion. And in this type of backdrop, assets and risk assets in particular tend to do the best. On the next slide, we would highlight that, the evidence of expectations for strong growth Firstly, for GDP, you can see in this slide that if you look at this top line, this would be the consensus forecast for global GDP. And you see for 2021, the expectation is for growth of 5.2%. This is higher than any growth level we've seen since 2010. And is considered very robust growth. And so most of the individual countries likewise are seeing growth rates higher than you would see historically. Obviously, this is because of it's a rebound year from 2020, but does provide a backdrop of growth. And then on the next slide, you can see that if you look at earnings, on this slide, you can see that if in fact you get a robust return in growth, that not only can you get back to pre-crisis levels, but given all the fiscal stimulus and monetary policy support, if you have a rollout of vaccines, then the sort of more blue sky scenarios that some economists are coming up with is that it's actually possible that we get above the trend line that we had pre-crisis. So that's not only getting back to pre-crisis levels, but a pre-crisis trend. So that's the outlook for GDP. On earnings, it's equally as strong. And as I mentioned in the poll questions, this is the EPS forecast for the S&P 500 over the last several quarters. Obviously, it fell a lot in the second quarter of 2020, but now, surprisingly as it may seem, analysts are expecting that by the second quarter of 21, that the earnings of the market will be as high as the earnings of the market back in the fourth quarter of 2019, and then continue to grow from there. And I think that's part of the justification on why we're seeing markets performing as well as they did. And then the third main element that we highlighted was the growth should be supportive of markets, the vaccines will be supportive of markets, but also the fact that interest rates will be low throughout the year. And so I like to highlight this chart, which is our projections on where we think the key interest rates for the main regions around the world will be over the next decade. And so what you can see is that we would expect that interest rates in the US remain low for 3 to 4 years, start to rise gradually, probably only rise to a level of about 2%, and then probably plateau around there. I can go into a lot of the economic reasoning behind this. I'd say some simple points to highlight, is that in the last 5 decades, the Fed funds rate peaked at a lower point than it did the prior cycle for each of the cycles for the last 50 years. Back in 2018, the Fed funds cycle peaked at 2.5%. In the cycle before that, it peaked at 5.5%. In the cycle before that, it was 6.5%. In the cycle before that, it was 9%, and so on. But this goes back 50 years now, and if the last cycle was 2.5, I think maybe we might get back to 2.5, but maybe a little bit lower. And I think most economists in the world are thinking probably peaks out this cycle around 2%. And so the other key part is I get a lot of questions about where will bond yields go, and in particular the 10-year bond yield. And I'd like to use this chart to explain how we think of this. Because what we would usually say is that when you invest in the 10-year bond, you can either sort of lock up your money for the next 10 years and buy that bond, or you could buy 1-year bonds every year for the next several years. And if the 10-year bond rate is as low as it is now at 1.1%, and you think interest rates are going to go up in a couple of years, well, then why not just buy a 1-year bond for now and then buy the 1 year, in the next few years once it gets above 1%? Why lock yourself in for 10 years? Well, the reason why you might do that is if the path of the 1-year bonds look like this orange line in the US, where you're at 0% for the first several years, sort of gradually rising for a few years, and then at 2% for like the next 5 years, that doesn't average out to very much. If you bought 1-year bonds along that path, you're maybe looking at 1 to 1.5% average. And so I think that's going to be the anchoring point for things like the 10-year. It's going to be hard for it to get to be too high because most investors are thinking like this. And if you're never going to get the Fed funds above 2% in the next 10 years, then how's the 10-year really going to get above that? Okay, so that's a little bit of the summary on our backdrop on growth and vaccines and rates. And I also had some points just to summarize. Another reason why the Fed, where we're pretty convinced the rates will be staying low, is that the Fed has given very clear guidance. They've said three things. They've said that they need full employment, they need to hit the 2% inflation target for a sustained period, and they need a risk of sort of rapidly rising inflation. And so what we point out to clients is that that's actually, may not sound like much, but that's actually a pretty tall burden in this sort of low inflation world that we live in. As a matter of fact, in the last cycle, I'm not sure those criteria were ever met. And if so, it was maybe only in 2018 where we might have had a couple of rate hikes. So I think it's, again, just to sort of emphasize, there's a lot of reasons to believe interest rates will remain low. And thus this view of sort of believing in lower for longer, I think, is going to still be a dominant theme for the next couple of years. And then the next issue, just to be clear what low interest rates mean, and I think it sort of, influences how all asset classes behave. But if your returns on safe assets have gotten as low as they are, right, 1% for a long-term government bond or near zero for a short-term government bond, then what it means is all asset classes are going to adjust for the relative risk premium they will give returns above. And another way of saying this is that there's two big conclusions. One, that long-term asset classes adjust to this. But near-term returns are likely to be healthy because the way markets will adjust this risk premium is by seeing rising valuations now. So I think it's sort of a two-step process. We should be aware as investors now, risk assets are probably going to perform because of that interest rates pushing things down. But it does mean that if you were to invest for 10 years, that historically things like equities might have delivered 8-9% per year on average, they're likely to be lower. And in fact, our numbers are looking more like closer to 5% on a long-term range, given how low interest rates are. And so that's going to force clients to make decisions, and they need to decide, will they continue to seek the returns they did and therefore take on more risk? Will they accept that the amount of risk they like to take, they don't really want to increase that, and they're just going to accept lower returns? I think it also implies that certain strategies like income and alternatives are likely to become more prevailing themes. And that I think there's also an issue that volatility is likely to remain high. When everyone is sort of investing with sort of getting pushed into higher valuations than they're comfortable with, there's likely to be jitteriness along the way. So next then, I guess just to sort of reemphasize these points, just to show you some of the data, we were highlighting that valuations will get higher as interest rates get lower, and we are seeing that. This is the PE ratio for the MSCI World. It usually trades at about 14 times, and we're currently seeing it at about near 20 times. And then in other markets, we see it also. This is the S&P 500. It usually trades at 15 times, and we're seeing it at 22 times now. And in Asia, Asia usually trades around 12 times and is trading at 16 times now. So again, all these markets, when you look at this type of chart, you see them looking a lot more expensive. The one sort of placating factor is the fact is if you adjust for the fact that interest rates are lower and that bond yields are lower, and you show this sort of chart on what we call a yield spread basis, then in fact, equities don't really look more expensive than they usually are. In absolute returns, those other charts show that they are more expensive, but given the fact that interest rates are so low, they're actually kind of being priced similar to how they usually get priced. So I think that's kind of the main encapsulation of our main points. I also kind of had an update. We were showing a chart like this back in before the elections, and we were highlighting what we thought would happen to markets under the blue wave or the status quo or Biden with a split Congress. And I think it's maybe just worth highlighting one more time because it was only a couple of weeks ago these categories got flipped on us again. There was a surprise in the U.S. with the Georgia elections that helped flip the Senate control back to the Democrats. So we would call this scenario more of a light blue wave. And then if you look at the left-hand column, the main message we were highlighting under this scenario is that for risk assets in general, it's pretty good. For emerging market assets, we think it's particularly good on a number of fronts. We think we get less rhetoric on the trade war. We think we get lots of stimulus that helps growth around the world. But one of the downsides is that it is likely that Democrats will increase corporate taxes. I think they were cut a lot under the Trump presidency, and I think Biden doesn't plan to push everything back to where they were, but a little bit somewhat in the middle compared to what the cut was. And if so, that's a little bit higher taxes on U.S. corporates. That wouldn't necessarily affect emerging market or Asian assets, but could weigh a little bit on U.S. assets. And then also to highlight that the U.S. election also points to a little bit of more deficit spending. That points to a weaker U.S. dollar and a potential risk in bond yields. So then that leads to our overall positioning. And so our summary is we recommend being overweight equities. Within equities, we are neutral the U.S., underweight Europe and Japan, but overweight Asia. And we would consider it a double overweight in Asia. We would underweight government bonds. We don't think the outlook is that bad, but we do think you're going to face sort of rising yields that'll take away returns that are already at very low levels. We do like credits. We think both investment-grade credits and high-yield credits can perform okay in a sort of risk-on environment. And we like alternatives, which kind of have more of a locked-in absolute return outlook, and the lower rate environment doesn't quite hurt that as much. And then we have more details on how we break out all our assets. I won't necessarily go through all our positionings, but certainly if you talk to UOB asset management representatives, we're happy to go through a lot of our views. Maybe some of the key elements here is that we are still a little bit short duration in fixed income. We're overweight emerging markets in fixed income. In commodities, we are overweight gold. Some of the other commodities, we do expect growth in the growth assets, but there's been a lot of volatility. And so one of our key focuses has just been using gold as a hedge to our overall portfolios, and we continue to use that even as things have steadied. And now I want to use the time to collect some questions. I think you have within your panels and consoles the ability to type in some questions, so feel free to do that. I think as many of you were registering for the event, many of you already sent in a lot of questions, and I was going through them. There were lots of them. There were really fascinating questions. I think we tried to summarize some of them that were looking quite popular. So I guess I see some on my screen already. I think some of these are the questions that were sent in. I think many of these are good. How about, I see a question here. It's, I think this is a fair one. Let me think. Okay, how about, I like this question. I get asked this a lot. So what's your views on the weak economy in the world and essentially the crisis, but with equity markets highs and strength? And I get asked this a lot, and I think that's fair. And I think when I talk to even my own family members, they say, "You guys in financial markets, it looks crazy out there. How can you justify when the whole world is suffering as much as is that these markets are reaching new highs?" And in particular, I think it was a client asked me, all those losses that were felt in 2020, where does that get registered? How can we be ignoring that? And so my answer would be that actually, as crazy as it seems, that equity markets do not register any value to last year's events. Equities in particular are forward discounting mechanisms. So I think, we talk about equity markets and it can sound confusing, but picture if you were just buying any business out there, you're buying a coffee shop on the corner. If it had a bad year last year because of the pandemic, but every year going forward is expected to be more normal, then you're going to value that based on what's going to happen in the next 10 years, not what happened last year. So the answer to my friend's question was really those losses are felt on the balance sheets of individuals like you and I, but the fact is they're not priced into the equity markets, and equity markets are just discounting the future. And so it seems pretty crazy in times like now, but if it's true that the vaccine rollout can occur, if it's true earnings by the second quarter are going to be as high as pre-crisis levels, then in fact you will see equity markets at these levels. So let's look at another question. How about, I see a question here about, I see a lot of questions about policy, both the expansionary monetary policy by the Fed, and I see questions about Biden's fiscal policy and what it'll do to interest rates and inflation and the dollar. And I think these are good questions, and I think some of this we have not seen before, so I think we should be humble about how much we can project. But I would say that the Fed policy of keeping interest rates low is in many ways similar to what we saw last cycle, even though in the last cycle, investors always thought we were on the brink of interest rates going up. And the Fed always seemed to talk like, well, next year they're going to be raising interest rates. Whereas as we start this cycle, the Fed's kind of giving more clear guidance. No, it's going to be several years before they're going to raise interest rates. And so I guess the first point on monetary policy is I think it's fair to project something like what we've seen before. But what is different is that the fiscal policy response looks set to be much larger than what we saw, for example, in 2008. Already what we've seen around the world is larger. And with Biden coming in as president, he's promising to do even more. And so given that, I think there is the possibility that we have to track inflation. Maybe this all adds up as inflationary again, and I don't think we can dismiss that. On the other hand, we've really been decades since inflation has been a problem. And in some way, I really feel like I need to see it before I believe it. So at this point, it's a little theoretical. I don't think we can rule out inflation. But at the same time, I think it's fair to be a little bit skeptical that it's proven to be hard to get inflation. And I guess the last part of that question is, what does it do for the dollar and rates? And I think it's similar to what I already presented. We do think that leads to a fairly soft view on the dollar, and we think rates remain benign. Okay, I see other questions. Okay, here, how about, I see a question about U.S. Corporate investment grade bonds. Okay, so the way I would summarize this is the investment the credit spreads have already tightened a lot. And in fact, they've gotten pretty close to pre-crisis levels already. So in some ways, a lot of that upside has been taken away by the rally that we just had. But on the whole, we would say that the credit backdrop and the scorecards that we show tend to point to a healthy backdrop. And I wouldn't be surprised even if we see spreads tighten to even more uncomfortable levels because of the way money is flowing around the world, and because interest rates are so low, investors will be forced to get into more risk assets like credit and equities. So for the most part, it's rallied a lot, but our call remains pretty positive. How about, I see another question here about the outlook for gold and gold prices. So there's a few parts of the story, and we tend to use gold kind of more on a sort of portfolio management basis. So a lot of the things that we look at for gold is how useful it is as a hedge, how does it perform in these parts of the cycle, what will protect us if inflation goes up. And so gold answers a lot of parts of this, and that and when we do portfolio analysis, generally the models would point to fairly significant levels of gold as being useful in a portfolio. I think the bottom line is I think gold will perform fine until interest rates go up, and especially if interest rates go up without ever really seeing inflation risk. If in fact we see inflation risk over the next couple of years, gold is going to prove very valuable. If in fact inflation is only moderate, but we get interest rate hikes, then that will be similar to what we would say what happened in 2013. That was the taper tantrum, and gold was performing all the way up well until 2013, and then it started to weaken after that. For now, I think low interest rates are here, and I would expect gold to be useful for at least a couple of years more. Okay, I think I see some more questions here. Okay, how about this one? I see, what will be the methods for the Fed to unwind its large balance sheet in the future? All right, so let's see, I'd say for the most part, the Fed's giving pretty clear guidance that they're really not that worried about that until they see inflation. And that they want to see inflation at 2% for a sustained period of time and a risk of it rising above that. Then they're going to unwind their balance sheet. And there's several tools they have. Obviously, selling down their levels of government bonds is on the table. Raising interest rates becomes part of that equation. And there's also other techniques. So it would be raising the interest rates that they charge to banks is another way to sort of manage their balance sheets. That keeps the banks from putting so much with the Fed. So there's a number of tools that they will use. They used these all this last cycle. And I think there's a general fear out there that the Fed's running out of tools in both directions, whether they want to tighten or loosen. But for the most part, I would hold the view that the Fed's still pretty powerful and really isn't running out of tools. And I think we saw that in 2020, that the Fed acted decisively and aggressively, and it really helped stabilize the downturn a lot faster than I think many people were expecting when it started. Okay, I think there's more questions coming in. I see a question here. It says, does the slow rate of the rollout of vaccinations concern you? I think I addressed this a bit in the presentation, but I would say, I think the way to think of it is, you know, in early January, I was starting to wonder, hey, should we be concerned? Because everyone's talking big numbers about the rollout of vaccinations in 2021. But as of the end of December, it looked really, really modest, and it made me nervous that we might not truly get these numbers that the pharma companies were talking about. But as we sit here today, and you know, especially in the last few days with the U.S. Rolling out and doing vaccinations at a clip of about 1 million a day, that makes me think that we don't have to be worried yet. I think we're just sort of in the initial phases of the rollout, and the more we see stories like Israel, I find that case fascinating. And, you know, in the back of my mind, I kind of hope that story for Singapore. Singapore is like one of those countries, the population's not so large and dispersed. If Singapore can get a hold of the vaccines, and I don't think money is going to be an object. I think for a lot of countries in the world, getting, you know, 1 billion doses to India is going to be very expensive. But for Singapore to get 5 million doses and, you know, a $35 a head cost is really not going to be that burdensome. And so I think there will be countries around the world, I hope Singapore can be one of them, that we end up being surprised how fast it can get rolled out. But I think most have, I think in the initial poll questions, we're saying it might not be until the end of the year. And that's a fair balancing point to think about. Okay, I think we have time for another question or two. How about this? I see a question here about property markets. I think this is interesting. What is your take on property markets and interest rates for 2021? So obviously I've talked a lot about interest rates. I've already said we really think there's a strong case to count on the fact that interest rates are going to be low for a while. And for property markets, that makes it very helpful for property. And I think there's evidence brewing that this is a pretty uniform story around the world, that property markets are doing well. In the U.S., that's kind of one of the strongest parts of the U.S. economy. In Singapore, when I've been tracking some of the more recent transaction data, I think there's signs of life. And I think we saw signs in Japan and Europe where property prices are looking pretty good and improving. And so I think this makes sense that as we get out of this, as we see low interest rates, and as we find the risk of that valuations in many markets are expensive, I suspect property markets are going to find support in this type of environment. Okay, I think we're down to our last couple of minutes, so maybe let me just give a summary and turn it back to Barry. My quick summary would be, I think, the investment backdrop in many ways looks fairly simple. I think to tell the story today is easier than most years. We have good growth, we have low interest rates, we have improving health. And our view, and I think many have developed a similar view, is that this is a healthy backdrop for investing. Much more stable, maybe not as dramatic and exciting as last year. Returns are probably going to be good, but only sort of high single-digit returns for equities, which is healthy enough, but certainly not as exciting as last year. But I think this is the type of investment I feel more comfortable advising clients to stay invested into. So anyway, thanks again for tuning in. I hope this helps and look forward to talking to you all in the future. So let me pause there and turn it over back to Barry. Thank you.
Thank you, Tony, for those market insights in the presentation as well as the Q&A session. Now we have come to the end of today's 2021 investment outlook. I hope you have gained some new perspectives and ideas for investing in the year ahead. Thank you so much for joining us. In an effort to improve our future progress, we would appreciate your valuable feedback about the session. We invite you to scan the QR code and please take a moment to give your feedback to us, or even let us know what you would like for us to discuss in the next webinar. Now, before we end, I would like to extend our invitation to everyone to join the next segment of our Ride the Markets with UOBAM webinar series. In the next segment, we take a look at the Asian investment landscape and what are the factors that will drive growth and greater investor participation in the months ahead. Do expect to receive an invitation from the UOBAM team soon. Thank you, and stay safe, stay healthy, and stay united. Goodbye.